The corporate space and the public sector operate on completely different rules. Assuming that a highly refined financial audit methodology is completely sector agnostic creates a dangerously incomplete audit. In the private sector, auditors rely on the International Standards on Auditing, or ISSA. These provide the disciplined global baseline to assure shareholders that commercial financial statements are materially accurate. Public sector auditing requires a parallel framework, the International Standards of Supreme Audit Institutions, or ISSAI. Moving from ISSA to ISSAI is not a technical rejection of financial math. It is an expansion of the audit's core purpose. An ISSAI audit must answer a broader question. It determines whether the math is correct and whether public power and money were used lawfully and effectively. Applying private sector logic to a public institution strips the audit of its public purpose. Mathematical accuracy cannot substitute for democratic accountability. To understand how these frameworks interact, we must map the distinct governing bodies that author them. The International Auditing and Assurance Standards Board, the IAASB, acts as the sole creator of the private sector ISSA framework. INTOSAI, meanwhile, is the global umbrella organization that produces the ISSAI framework used by national Supreme Audit Institutions. This overlap is intentional. ISSA methodology is embedded perfectly inside the public sector's financial audit standard, ISSAI 200. ISSA remains the baseline for reasonable assurance and evidence. However, the INTOSAI shell extends outward, adding branches ISSA doesn't cover. ISSAI 300 for performance audits, examining economy and effectiveness, and ISSAI 400 for compliance audits, focusing on strict legal adherence. You will also see IFAC in this ecosystem. They support the accountancy profession as a whole, but they do not author these specific audit standards. While a private sector financial audit represents the entirety of the ISA framework, it is only one component within the broader ISSA house of accountability. These differences stem from the audit mandate, the legal authority under which an auditor operates based on who owns the capital. In the private sector, accountability flows in a closed loop. Management is audited by the ISA auditor, who reports to the shareholders. This verifies the stewardship of voluntary investments. The public sector chain is wider. Public officials are audited by the Supreme Audit Institution, which reports to Parliament and citizens. This verifies funds extracted involuntarily via taxation. This transition from private owners to public citizens widens the scope of what the auditor must examine. It moves beyond corporate profits into the mechanics of budget execution, emergency procurement, and grant eligibility. To execute this mandate, public auditors need different access rights. While private auditors rely on contracts, public auditors use statutory powers to demand government records. These powers are anchored in the Lima Declaration, which guarantees that Supreme Audit Institutions have the independence to follow public money through complex government networks. The public mandate transforms the auditor's role. They are no longer an agent of private capital, but a constitutional defender of public resources. Under ISSA, risk assessment is focused on material misstatements, errors large enough to change a shareholder's economic decision. The auditor hunts for inherent risks like complex inventory valuations or liquidity pressures that might threaten the balance sheet. ISSAI risk assessment must also account for political realities and the strict boundaries of public finance law. Public inherent risks include things like complex budget transfers, statutory grant conditions, and the speed of emergency procurement cycles. Standard ISSAI materiality is quantitative. It's a threshold usually based on a percentage of profit or revenue. This is the materiality trap. Private sector logic relies on an x-axis of monetary value. The public sector adds a y-axis for qualitative impact, like legality and trust. Consider a small procurement error. Sitting on the far left of the x-axis, it's quantitatively immaterial in a private audit. But under ISSAI, that same data point shoots rapidly up the y-axis into the red highly material zone because the error breached a budget law or revealed unfair competition. This shift changes how we value evidence. An invoice proves an expense occurred, enough for a financial audit. That same invoice is useless in proving it was legally compliant. In the public sector, a financially trivial error is material if it destroys public trust or breaches statutory authority. These frameworks unify into a single model for public sector oversight. This Venn diagram shows the three pillars of the INTOSAI framework. Financial audit relies on ISSAI methodology for numerical accuracy. Compliance audit ensures strict legality. Performance audit assesses the economy, efficiency, and effectiveness of government spending. The outer boundary is public trust and accountability. For an audit to be reliable, the boundaries between these methodologies must remain rigid. Proving that a government program followed the law does not automatically prove it achieved value for money. Likewise, a performance audit does not provide an official opinion on the accuracy of financial statements. Mastering the ISSAI framework ensures that public managers are held accountable for their accountant math and for their total stewardship of public power.